Greetings, everybody. Welcome to the weekly economic update. It is Monday, October 24th, 2022. I hope everybody had a fantastic weekend. Pretty good for me. You can see Barney back here over my shoulder. He is very excited about the Astros headed back to the World Series. And so definitely made my weekend watching the Astros sweep their way through the playoffs so far. So pretty good. So market's pretty good today. So I think a lot of people think that what the Fed has been doing the last few months has, going to bring a quick end to the inflation. I'm not totally bought in on that, but things aren't as bad as they seem. I know I've had a lot of meetings and said the same thing over and over again as I feel like I'm repeating myself, going through the same spiel during my client meetings right now, but it's kind of a glass half full, half empty. Some things are good, some things are bad. There's too much money in the money supply right now, which is what has been the main culprit for all the inflation that we're seeing. But again, there's jobs out there. There's ways to make a living, and you just have to kind of roll with the punches. So, all right, if it's your first time watching, please hit the subscribe button so that you can get notified every time that I go live. I do this daily around 2:20 every afternoon Mountain Time. And please give me some thumbs up, like, share, all that good stuff. I would greatly appreciate it. So let's go ahead and dive in and take a look and see how the markets did today. The Dow Jones was up 1.34, closed at 31,499. SP was up 1.24, closed at 37.99. NASDAQ up 0.86, closed at 10,952. Small caps are up 0.2. The VIX up, even though the market was up, the VIX was up 0.54. It's currently at 29.85. Canada was up 0.3. Brazil down 3.26. I wonder what happened there. Mexico up 1.39. Jumping across the Atlantic, Germany up 1.58. UK up 0.64. France up 1.59. Euro stocks up 1.47. Netherlands was up just 0.17. They've been dealing with a lot of inflation there. Spain up 1.79, Italy up 1.93, Switzerland up 1.7, Portugal up 1.3. In Russia, they were the MOEX up 0.99, RTSI was up 1.15. Headed over to the Asian markets last night, Japan was up 0.31, Australia up 1.54, New Zealand up 0.41, and looks like the Chinese markets are mostly the red. The Shanghai was down 2.02, SESE component down 2.06. China A50 down 3.93, DJ Shanghai down 2.16, and the Hang Seng fell 6.36. So, I need to do some reading on what happened in the Chinese markets. It's looking pretty bad, at least for today. And the Taiwan weighted came in up 0.29. So, not fantastic if you're heavily invested in the Chinese markets right now. So, all right, well, let's dive into this week's weekly economic update. The week on Wall Street. Positive start to a new earnings season and late week hopes of a near-term easing in Fed rate hikes lifted investor spirits and powered stocks to gains for the week. The Dow Jones Industrial Average jumped 4.89, while the S&P 500 advanced 4.74. NASDAQ added 5.22, and the MSCI, which is internationals, overseas, gained 1.66. Earnings and Fed spark rally. The stock market narrative shifted last week from the Fed interest rate hikes, a persistent drag on investor sentiment, to corporate earnings, which boosted investor enthusiasm with better than expected results. Stocks surged in the first 2 days of trading on the strength of positive earnings surprises, aided by a modest pullback in bond yields and the news that the UK was scrapping its tax cut plans. Midweek, stocks surrendered some gains on stronger US dollar and rising bond yields, but on Friday, comments by a Fed official that hinted at a possible relaxation in Fed rate hikes sent stocks soaring to close out a good week. Better than expected. Investors were approaching the new earnings season with a fair amount of trepidation amid an environment of higher interest rates and a slowing economy. The concern has been that poor earnings may drag stock prices lower from current levels. Early earnings results have provided investors with mostly positive surprises, with 88 companies comprising the S&P 500 reporting. 75 reported profits above analyst expectations, well above the 66% long-term average. All right, so economic data this week. Monday, we have the Purchasing Managers Index Composite. Tuesday, we have consumer confidence. Wednesday, new home sales. Thursday, we have jobless claims, durable goods sales, and gross domestic product. I know I've been talk a lot in meetings and talk about the GDP, and have an article at the end that I'm going to talk about or read through that talks about what the expectation is for the GDP for this quarter, or for the third quarter. Earnings this week, Tuesday, we have Microsoft, GE, Visa, Alphabet, which is Google, General Motors, Coca-Cola, Archer Daniels Midland, 3M, Texas Instruments, UPS, and Kimberly-Clark. Wednesday, we have Boeing, Ford, Bristol Myers, ServiceNow, General Dynamics, Norfolk Southern Corporation. Thursday, we have Apple, Amazon, Intel, MasterCard, Caterpillar, Merck, McDonald's, I'm loving it, Northrop Grumman, Comcast Corporation, Southwest Airlines, and Friday to close out the week, we have AbbVie, ExxonMobil, Chevron, and Colgate-Palmolive. So it's a busy week for earnings, so we'll see if that trend continues through the week. All righty. Let's jam through today's market recap. S&P 500 rallies ahead of busy week for big tech. The S&P 500 rallied Monday, adding two gains from a strong week earlier. As investors looked ahead to a wave of quarterly results from big tech, defensive corners of the market including consumer staples and healthcare, led gains in the broader market, with the latter boosted by a nearly 7% jump in HCA. Sentiment on healthcare stocks has improved as investors weigh up sectors that could be less vulnerable to risk of slowing economic growth and higher interest rates. Quote, our overweight recommendations, healthcare, consumer staples, telecom, and energy, are generally defensive and reflect the significant risk to earnings and valuation in an environment of elevated inflation and interest rates, end quote, Goldman Sachs said in a note. The outlook on the economy deteriorated further following weaker than expected manufacturing and services activity. The weaker data forced Treasury yields to ease slightly from session highs and boosted tech stocks amid the hope that the Federal Reserve may consider a less hawkish path of monetary policy after its widely expected 75 basis point rate hike next month, which is going to be on November 1st and 2nd is their next meeting. Apple rose more than 1% after raising the price of its TV and music streaming services. Alphabet, which is Google, and Microsoft are set to kick off quarterly earnings for big tech on Tuesday, with Meta Platforms, Apple, and Amazon set to report later in the week. Chinese tech stocks, however, suffered a rout as Alibaba and JD.com Inc. slumped after Chinese President Xi Jinping's leadership reshuffle raised fears about increased regulatory scrutiny on tech stocks. Consumer discretionary stocks were one of the few sectors in the red, weighed down by a slump in China-sensitive casino stocks following a fresh COVID-19 restrictions in Guangzhou. Melco Resorts and Entertainment, Las Vegas Sands, and Wynn Resorts Limited fell sharply. Energy continued to hold gains, shrugging off stuttering oil prices following a 3% rise in oilfield services company Schlumberger. Goldman Sachs lifted its target price of Schlumberger to $55 from $46, following the company's better guidance for fourth quarter 22 and increased conviction in 2023 and 24 revenue growth driven by international activity, end quote. All right, that was a mouthful. So, but, kind of things look pretty good right now. Like I said, at the beginning of the broadcast, it's kind of things are good, things are bad. You could cherry pick things and see things that are terrible or things that are just awesome. I try to put, everything together and say, well, here's the good, here's the bad. You take them both and there you have the facts of life. The facts of life. All right, you didn't come here to watch me sing. Next up, Wall Street rises as data hints at Fed policy progress. Wall Street advanced on Monday, building on last week's gains as signs of economic weakness suggested the effects of the Fed's aggressive policy aimed at cooling the economy, thereby curbing decades-high inflation, are beginning to be felt. We'll see. After three major U.S. stock indexes were higher at the top of the week, jam-packed with high-profile corporate earnings and crucial economic data, a report from S&P Global showed a contraction in business activity this month, offering a hint that the Federal Reserve's barrage of steep interest rate hikes are having the desired effect, raising hopes that the central bank could begin slowing the pace of increases to the Fed funds target rate. Quote, we're getting some follow through from what we saw last week. This idea that while the Fed may not be pivoting, perhaps the cadence could be slowing in terms of rate hikes, end quote, said Chuck Carlson, Chief Executive Officer at Horizon Investment Services in Hammond, Indiana. Quote, there seems to be some idea that the rate environment is not going to be as aggressive as we move into next year. Again, we will see. Here is a chart of and let me make this a little larger. These are the interest rates that we're at right now. Right now, the Fed funds rate is at 2.56 as of September. And, we can see that, we're just as high as we were at 2019 when the market was starting to stumble at the end of 2019 going into 2020. And you can see where the rates were actually slashed a little bit going into the first quarter of that year. I think that probably had to do more with the election year. But again, we look back here in the late 70s, early 80s, where interest rates were up in the high teens. That's what got inflation way back down. Right now, inflation is running 8.2%. And, back then they got rates above the rate of inflation to get it down very quickly. What we're doing right now, if inflation is 8 something and rates are at, 2 to 3, we still have a ways to go, in my opinion. If they do any, I'd actually like to see them speed this up. But again, I don't anticipate that's going to happen anytime soon. So take that information for what you will. It could be worse, could be better. But, my fear is that if the market stumbles even more and starts to capitulate in the early part of 23, that if the Fed starts printing money, doing more QE, that we're just going to wind up in the same spot, 2 to 5 years down the road. And we're going to be in the same pickle with more inflation because of all much more dollar creation down the road. So we shall see. All right. Last article here comes from our friends at First Trust, Brian Westbury, their chief economist. It's titled The Last Hurrah. It has to do with his expectations for the Q3 GDP numbers. All right, let's dive in. Most investors we talk to think the U.S. is already in a recession or that the recession will start by the end of 2022. We think they're wrong on both counts. Yes, we are fully aware that reports on real GDP growth for the first 2 quarters of the year were negative, but as economists, we are also aware that GDP reports will be revised once a year for several years, and they are confident they will ultimately show positive growth. Why? Because the unemployment rate has dropped, payrolls have grown at a very rapid pace, and industrial production continues to climb. All those are true. Don't get us wrong, we're not recession deniers. We think a recession is coming because monetary policy will have to get too tight to bring inflation back down to a monetary policy tight enough to do that will likely drag the economy into recession. We're just not there yet. We expect a recession to start in the second half of 2023 with some risk of it starting in either the first half of 23 or the first half of 24. In the meantime, as we set out below, our calculations show economic growth at 3% annual rate for the third quarter, which is probably going to be the fastest growth we see for any quarter from now until the recession is done. First up is consumption. Real inflation-adjusted retail sales outside of, the auto sector declined at a 1.4 annual rate in Q3, which sales of autos and light trucks slipped at a 0.4 rate. However, it looks like real services, which make up most of consumer spending, should be up at a solid pace. Putting it all together, we estimate real consumer spending on goods and services combined increased at a modest 1% rate, adding 0.7 points to real GDP growth. 1.0 times the consumption share of GDP, which is 68%, which equals 0.7. Business investment, we estimate 5.8% annual growth for business equipment investment, a 7.4% gain in intellectual property, and no change in commercial construction combined. Business investment looks like it grew at a 5.6% rate, which would add a 0.7 points to real GDP. I'm not going to go into all the details again like I did in the last one. Home building, amid higher mortgage rates and buyer skittishness, residential construction looks like it fell at a 16.5% annual rate. A decline at 16.5% rate would subtract 0.8 points from real GDP growth. Government, remember, only direct government purchases of goods and services, not transfer payments like unemployment insurance, count when calculating GDP. We estimate these purchases, which represent 17% share of GDP, grew at a 0.6% rate in Q3, adding 0.1% to real GDP growth. Trade. Exports remain very close to all-time highs in Q3, while imports have declined sharply, in part a reflection of businesses with too much inventory cutting back on foreign purchases. This means a smaller trade deficit. At present, we're projecting net exports will add 2.7 real points to GDP growth, though a report on trade deficit in September, which arrives on Wednesday, may alter that forecast. Inventories look like they grew at a slower pace in the third quarter than they did in Q2, suggesting a drag of about 0.4 points on growth rate of real GDP. However, just like with trade, a report out Wednesday may alter this forecast. You add it all up and we get a 3.0% annual real GDP growth for the third quarter. An economic storm is coming. The sun is still shining today, but with almost all the net growth in Q3 coming out of the trade sector, the clouds are forming on the horizon. All right. So, according to Mr. Westbury, he thinks things were pretty good for Q3, and that should help out things for the year. So, again, we shall see. Also, we do have to deal with Q4, but Q4 is usually pretty strong with all the holiday spending and everything that's involved there. So, personally, my belief is that things will really start to stumble next year. That's just my own kind of gut reaction, just looking at everything and in my own personal view. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. If you'd like to book a meeting to get your finances in order, do some financial planning, retirement planning, college planning, whatever it might be, you can book a meeting and we can get started on that. Otherwise, I'll be back tomorrow with the Liberty Call, and I hope everyone has a fantastic night. Bye-bye, folks.